Hello everyone, welcome back to another video. If you're new to this channel, my name is Farhan and I help accounting students like you ace their exams. Today we have got a practice question which requires you to prepare the accumulated depreciation ledger account. In this account, you'll be working with multiple years of transactions before you can finally have everything condensed into one ledger account covering one specific financial year. You can see the question on the left hand side of your screen. And on the right hand side, we have all the workings, which I'll explain and go through step by step. What I need you to do now is focus and follow through the entire content for an excellent understanding. With that being said, let's begin. On 1 April 2013, Willie Proprietary Limited purchased two equipment by check at $16,000 each. On 16 June 2015, Willie sold one of this equipment for $10,000 on credit to Zen Limited. On the same day, Willie bought another equipment for $9,000 by check. This equipment, which was bought on 16 June 2015, has a scrap value of $1,000. The business policy is to depreciate all equipment at 25% per annum using the reducing balance method. A full year's depreciation is provided in the year of purchase and no depreciation is provided in the year of sale. All right, so based on what we have read so far in this question, we understand that on 1 April 2013, our company Willie purchased two assets. And each of these assets had a cost of $16,000, which means altogether the total amount spent on 1 April 2013 for these two assets is $32,000. Okay? Then on 16 June 2015, which is almost after 2 years, these assets were bought. We sold one of these assets for $10,000. And also on that same day, we bought a new asset which had a cost of $9,000. Okay. The requirement of this question is also that we apply a full depreciation in the year of purchase and no depreciation in the year of sale. And the business policy is to use the reducing balance method at 25% per annum. Okay. So our requirement in this question is to prepare the accumulated depreciation account for the year ended 31 March 2016. So the question clearly specifies for the year ended 31 March 2016, which means we are interested in everything that has happened in the financial year starting 1 April 2015 and ending 31 March 2016. Okay, so I'll just make a note of that here. So whatever happened in between 1 April 2015 and 31 March 2016 with regards to our accumulated depreciation calculations is what we are mainly focused on. Now, if I can also have your attention on the right hand side where we have all the workings, let's see how we can handle this question. So we understand that we are working with a business where the financial year typically starts on 1 April and ends on 31 March, okay, of the following year. So year one for this assets, which we have bought initially, would be from 1 April 2013 all the way until 31 March 2014. Okay, so these are the 12 months that we are concerned about. So in the first year, based on the business policy, we are to apply a full depreciation, right? And the full depreciation can be derived by multiplying the given percentage with the original cost. The given percentage is 25%, and the original cost for one of these assets is $16,000. We are calculating the depreciation for one asset to simplify our calculations, and we will simply double this amount at the end. So not to worry about it at the moment. So 25% multiplied by 16,000 gives us $4,000 as the full depreciation, which is, as we understand, valid for one asset or one equipment only. Okay? Now, every time you are using the reducing balance method for calculation purposes, I recommend you also find the net book value at the end of the financial year. In this case, we want to find the net book value at end of 31 March 2014, which is simply the difference between the cost and the accumulated depreciation. The accumulated depreciation simply stands for the total depreciation expense we have accumulated or aggregated so far since the day of purchase. Again, we're finding the net book value at this point in time for only one asset, which is $16,000 being the cost, minus $4,000, which is the depreciation expense we have derived for year one, which gives us a net book value at 31 March 2014 of $12,000, which is again valid for one asset only. All right. Now, we want to find the total depreciation expense for two assets combined, and each of these two assets have similar characteristics given that they were bought on the same day, they go through a same depreciation policy, they're depreciated at the same rate, and also they cost the same. Okay, so the total depreciation for two assets now can simply be multiplied by multiplying $4,000 with 2, which is $8,000. And where did we get $4,000 again? $4,000 was the individual depreciation for one of these assets, which we had done at the beginning. Okay, so altogether, the total depreciation in year one for both these assets combined is 4,000 times 2, which is $8,000. Okay, now we're moving to year two. Year two starts on 1 April 2014 and ends on 31 March 2015. All right, and you have to be very careful with regards to the years. Okay, so these are the 12 months that we are focused on now. And because we're using the reducing balance method, when you move from year one to year two, depreciation is simply calculated by multiplying the given percentage with the net book value. Okay, the given percentage in this case is 25%. And the net book value, if you recall, for one of these assets is $12,000 at the end of year one, all right, which gives us a depreciation in year two of $3,000, which is again valid for one asset only. Now, you might wonder what's the real meaning of reducing balance method. Well, I want to show you something. You see, for one of these assets in the first year, the depreciation we calculated was $4,000, right? Where we calculated the depreciation by multiplying the percentage with the original cost. When you move to year two, we are calculating the depreciation by multiplying the percentage with the net book value, which results in a lower depreciation compared to year one, and that is $3,000, as you can see. All right. So the logic where companies mainly decide to use the reducing balance method is when they believe the asset is more functional for revenue generation purposes in its earlier years of usage compared to its later years of usage. Like it's more efficient in helping us do our business or run our operations in the earlier years. And that's when it makes sense to apply the reducing balance method. Okay? All right. Now, because we're using the reducing balance method, we also want to find the net book value, and the net book value is being calculated at 31 March 2015, which is at the end of year two. We understand that the net book value at any given point in time stands for the difference between the cost and the accumulated depreciation. Since we already know the net book value at end of year one, it makes real sense or logical sense to actually just deduct $3,000, which is the depreciation expense we have incurred for year two, right? So we take the net book value that we had got at end of year one, which was $12,000, and then we deduct $3,000, which is the depreciation expense for one of these assets in year two. That gives us a net book value of $9,000 at year two for one of these assets. Now, what do we want to do? We want to find the total depreciation expense, all right, for two assets combined. So the total depreciation expense is the amount which we are going to report in the income statement under the expenses section, all right? So the total depreciation expense for two assets is basically $3,000 for one of these assets, which we had calculated earlier, multiplied by 2 altogether, which gives us $6,000, okay? All right. Now, before we move to year three, I also have a question for you. What is the accumulated depreciation of equipment so far? Accumulated depreciation has a different meaning to the depreciation expense. Depreciation expense is valid for the specific financial year, right? Which is the specific financial year ending 31 March 2015. But accumulated depreciation is all the depreciation that we have got so far for this asset class, which is equipment, since the initial purchase, which is the total of year one and year two. So in year one, the total depreciation for two assets was $8,000. Now in year two, it's $6,000. Altogether, the accumulated depreciation for equipment for years 1 and 2 combined comes out to be $14,000. Okay? Now, why did we have to know this? This is going to be important when we prepare the ledger account. So we'll come back to this eventually. All right. Now we are moving to the third year. The third year will start on 1 April 2015 and end on 31 March 2016, which is mainly the financial year of concern for this question that we are solving the ledger account which we are preparing for the 12 months starting 1 April 2015 and ending 31 March 2016. First of all, we have to look into all the events in chronological order that happened during this financial year. The first one being the sale of asset or the disposal of asset. Based on the business policy, we understand that no depreciation is provided for in the year of sale. Okay? Now, if you recall, the net book value for one of these assets, which we have sold in year 3 on 16 June 2015, is $9,000, the net book value which we derived at the end of year 2, right? Now, the disposal proceeds, which the question clearly mentions, the amount that we have received by selling this asset, which is $10,000. I'll just highlight this in red. You can see on 16 June 2015, Willie sold one of the equipment for $10,000 on credit to Zen Limited. Okay, so $10,000 here refers to the amount that we expect to receive by getting rid of this asset. Now, the day we sold this asset, the net book value was 9,000, but we ended up selling this for 10,000, which obviously means we ended up selling it for more than what it was worth. The net book value basically refers to the economic benefits that are still available for consumption within this asset. So the economic benefits available for consumption on the day of sale was 9,000, but we ended up selling it for 10,000, which means that we have ended up selling it for a gain or a profit. And the amount of profit we have made on this sale is simply the difference between these two amounts, which is 10,000 and 9,000. So which gives us a gain of $1,000, which we have made during this sale of asset. Okay. Now, next we have to depreciate the remaining old asset. If you recall, initially on 1 April 2013, we bought two assets at a cost of $16,000 each. Now, one of these assets have already been sold, which you had just looked into that we had taken care of. Now, what about the other remaining old asset? The other remaining old asset was still in usage throughout the business for the entire financial year, and there is to be depreciated using the reducing balance method by simply multiplying the given percentage with the net book value. The given percentage, as you understand, is 25%, which is mentioned in the question, and the net book value at end of year 2 for one of these assets is $9,000, which gives us a depreciation of $2,250 for this remaining old asset. Okay? All right. Now, we have to look into the purchase of the new asset. If you read the question carefully, you would see that it's saying that on the same day, Willie also purchased another equipment for $9,000 by check, and this equipment purchased on 16 June 2015 has a scrap value of $1,000. Now, the scrap value basically refers to the amount which we can expect to receive by selling this asset at the end of its useful life. Whenever you're using the reducing balance method, you don't have to worry about the scrap value in your calculations. The scrap value is only important if you are actually using the straight line method. So in this case, we will ignore this, okay? Now, so based on the company policy, for any new assets that are purchased, in the financial year of purchase, a full depreciation is to be applied. So we calculate a full depreciation by simply multiplying the given percentage with the cost, and the cost in this case is $9,000, which is clearly mentioned in the question. Again, I'm just circling it so that you can see it. So that gives us a depreciation for this new asset to be also $2,250, okay? All right, so if my question to you is, what is the total depreciation expense in the financial year, which starts on 1 April 2015 and ends on 31 March 2016, the 12 months of concern? It's going to be 2,250, which is the depreciation we have derived for one of the remaining old assets, plus an additional 2,250 for the depreciation of the new asset that which we have purchased altogether, which gives us $4,500 as the total depreciation expense for the 12 months starting 1 April 2015 and ending 31 March 2016. And this $4,500 is also what we will report in the income statement under our expenses section. Okay? All right. Now, let's look into the preparation of the accumulated depreciation ledger account. If you recall, we are required to prepare this ledger account for the year ended 31 March 2016, which means everything that has happened with regards to accumulated depreciation from 1 April 2015 until 31 March 2016 is what we will focus on. Now, here I have an outline already created for the accumulated depreciation ledger account, which is the usual 5-column format, with the date being in the first column, followed by the details in the second column, the third column having all the debit totals, and the fourth column having all the credit totals, and the fifth column has the net balance figure. Now, the financial year starts on 1 April 2015, and we're going to start with our opening balance, which is what we write as balance brought down. Now, what is this opening balance? 1 April 2015 is the beginning of year 3. And if you refer back to our workings, you will see that at the end of year 2, which is at end of 31 March 2015, right, we found out the accumulated depreciation for 2 of those assets combined, which was the aggregate depreciation for years 1 and 2 combined, and that was $14,000. This $14,000, which we have as the accumulated depreciation at 31 March 2015, will be carried forward as the opening balance on 1 April 2015. All right. So we know the amount is $14,000, which is the opening balance on 1 April 2015. I'm sorry, but where should we report this? We should report this as a debit or a credit. Always remember that accumulated depreciation in itself is a contra asset account, which means that this is an account which records the reduction for a relevant non-current asset account, and the relevant non-current asset account in this case is the equipment account. Because accumulated depreciation basically records the reduction that we have for our non-current assets, it is a contra asset account, and by default, the opening balance should always be on the credit side, which also means when accumulated depreciation increases, we credit it within this account, and when it decreases, we debit it within this account. So because we have $14,000 as an opening balance, it is to be recorded at the very end, and the net balance has to be credit because it is a contra asset account, and by default, all contra asset accounts should have an opening balance on the credit side. Okay? Remember, this is not an asset account. It is a contra asset account, which is specifically there to record the reduction for the equipment account. Okay? All right. Now, what's next? In chronological order, after 1 April, we have got some transactions happening on the 16th of June. On the 16th of June, as you know, we have sold one of the assets for $10,000. Okay? Now, the asset which we have sold is no longer going to remain in the books. Therefore, our accumulated depreciation ledger account must reflect this fact. Okay? So what's the journal entry when we are selling a non-current asset? What's the journal entry specifically to remove the effects of depreciation from the books when we are selling a non-current asset? We are to debit the accumulated depreciation account because, as you understand, the accumulated depreciation is going down because we are selling it, so the asset no longer remains, with the opposing entry being the credit for sale of non-current asset account because we are removing this depreciation mainly because we have sold this asset, right? Now, the question here is how much is the amount for accumulated depreciation for this asset which we have sold? So let us scroll back up to our disposal calculations, and you can see the original net book value for the asset which we had sold was $9,000. But if you recall, I've got some questions for you. What was the original cost that we paid to buy this asset on 1 April 2013? It was $16,000. So if the net book value is $9,000 and the cost was $16,000, that means we have an accumulated depreciation of $7,000, which is simply the difference between $16,000 and $9,000, right? Now that we have to remove this asset from the books, we have to decrease our accumulated depreciation, which means when we have to decrease our accumulated depreciation, we have to debit it. Because normally when accumulated depreciation increases, we credit it. So now that we have to decrease it, we debit it. And the reason we are decreasing it is because we have sold it. That is why the sale of non-current asset account takes the credit entry here. So as you understand, accumulated depreciation is being debited, and it is mainly debited within this journal entry due to the fact that we have sold it. That's why when you refer to the ledger account, you will see that on the 16th of June 2015, within the details column, we have included the narration or the cross-reference for the account to be sale of non-current asset. You can write the full form in exam, don't write NCA like me, all right? And that is going to be recorded on the debit side because we understand the accumulated depreciation is decreasing in value, okay? Now, what's the net balance at the end of this transaction? As you understand, we have got 7,000 debits here, and initially we had $14,000 credits. So obviously there is a difference here. So what do we have to do? So we have to subtract 7,000 from 14,000, which gives us a balance of 7,000. And again, the net being credited because we have more credits than debits still, okay? All right. Then what happened? Then we have got the depreciation expense, which we will record at the end of the financial year on 2016, 31 March, okay? And the total depreciation expense is $4,500. What do we have to do in this case? If we want to journalize this, we would debit the depreciation expense account by 4,500 and we would credit the accumulated depreciation account, okay? Again, we are debiting the depreciation expense because our expenses are going up as we are utilizing these assets. And when expenses increase, we debit them. And at the same time, we are crediting the accumulated depreciation because accumulated depreciation, when it increases, it's credited because of the fact that it is a contra asset account. And by default, all contra asset accounts, when it increases, should be credited. So as you understand, the accumulated depreciation account must be credited. That is why the accumulated depreciation account has this entry at 31 March 2016, which is 4,500 to be recorded on the credit side simply because it's going up in value due to the additional depreciation expense which we have incurred in the last financial year, okay? So we have new credits that are going to be now added to the $7,000 credit balance which we had at end of 16 June 2015, which gives us a total balance of 11,500 credit. And this is what we will carry forward as the opening balance on 1 April 2016, starting the new financial year, all right? And that is going to be 11,500 credit. Obviously, it's credit because it's a contra asset account. And by default, all contra asset accounts should have an opening balance on the credit side, simply because contra asset accounts are specifically there to record the reduction for a relevant non-current asset account. And the relevant non-current asset account in this case is the equipment account, okay? All right. So I believe this question is quite important for your exam if you want to score full marks. And I believe this question clears doubts that you have had originally. You can also check the other videos on accumulated depreciation account, sale of non-current asset account, and also preparing a regular non-current asset account, which you can find in the videos that I've uploaded in the past. With that being said, I'll conclude today's lesson and I'll see you in the next one.